Fund Your Future with DRS. Today, we're taking a deeper dive into Medicare. And in general, Medicare is supposed to make healthcare more affordable in retirement, and it does. But some retirees are surprised to learn that sometimes if they have a higher income, it can trigger some Medicare surcharges that add a couple $100 to their premiums. So we're talking about some of these extra costs that are generally referred to as IRMAAs, IRMAA, which stands for income-related monthly adjustment amounts. And to help us sort through the details, we're joined again by Tim from the SHIBA program, the statewide health insurance benefits advisors. And we're happy to have you here, Tim. I know that you help retirees navigate Medicare every day.
Thrilled to be back again, Jenny. So much grateful for the invitation to DRS.
And SHIBA program is part of the Office of the Insurance Commissioner.
It is. So I am, like you, a state-employed person. We always have to start with the sad reality that lots of people don't know there is an Office of Insurance Commissioner, but we are one of the 9 separately elected officials in the state, and we are part of the Consumer Protection Division of the Office of Insurance Commissioner.
And for those of you who didn't listen to episode 19, the first time we had Tim on the podcast, could you just remind us what the SHIBA program is?
Of course. And I'm happy to say that we're celebrating 50 years this year. The program was initiated 50 years ago by a group of local volunteers in Stanwood, Washington. And it sounds kind of quaint to say this, but they thought, gosh, Medicare is pretty complicated. Wouldn't it be nice if you could talk to somebody about it and not have to, go to an agent or a broker necessarily? But the program has been part of the Insurance Commissioner's Office for more than 45 years. And the idea is that it's peer-to-peer counseling. So someone who's a motivated volunteer who's trained by our office can meet with you in person or on the phone or virtually and help you navigate through the complexities of Medicare.
Yeah, I think this is just super awesome program that they offer.
Thank you.
So, Tim, to prepare for this episode, I should first mention that this was a listener request. Actually, I think more than one listener has requested this over time. And the first time, Jenny and I were like, well, we're not qualified to talk about this, so we're going to skip over. And then the second or third time we got the question, we're like, okay, we need to phone a friend. We'll call Tim and see if he can help us understand a little bit of this. So I did a little bit of quick internet research, and I don't usually trust ChatGPT and all the other tools, but it did help me understand a little bit about, I just was searching Medicare and high income, and it provided a real long laundry list of these surcharges, and as Jenny mentioned, frequently referred to as IRMAA. Can you just help our listeners understand what the threshold for income is that we're talking about as a retiree, somebody who's on Medicare that may then qualify? Qualify sounds like a wrong word. Like qualify is usually a good thing, but meet the threshold for this.
Sure, of course. And maybe just a little bit of context. Likely the reason you're getting the question is because people are sort of startled to find out there is such a thing. So in general, we think of one of the good qualities about the Medicare program is that it's kind of universal. It's the same for everyone. But this is a relatively new provision of the Medicare program that was designed to help kind of put the brakes a little bit on the increasing cost of Medicare to the federal government. And so the idea is that a small number, a few percent of the highest income earners pay, as you said, Seth, a surcharge. They pay more than kind of the market rate for Medicare. And again, that's just to help take some of the pressure off the cost to the government of the Medicare program. It generally is going to be a thing that people encounter when they're first starting in Medicare, right? Because they may be having a relatively higher income when they're working, and then across that transition to retirement, they're going to experience a lower income. So it commonly is a thing that's happening when people are just getting started in Medicare, and their research may just not have extended all this way. It may not have occurred to them that there is such a thing as a higher premium for higher income earners. So specifically, every year, the IRS determines what this threshold amount is. And then it is the Social Security Administration that actually is responsible for deciding whether you, Seth, have a surcharge or you, Jenny, do not.
Okay. And so it's based on my total income. I hadn't thought about this situation where people go on Medicare starting at age 65. We know lots of people are still working beyond 65, but it Medicare may be more expensive for them while they're working, and then when they eventually retire, they will see their Medicare costs decrease because their income will then fall below the threshold. That's what you're saying.
That's exactly right. And this is a very common challenge that we have and something we'll talk about today in our time together. So the first thing to know is the assessment or the surcharge. I'll just say my wife and I just filed our income tax return. So on your income tax return, there's the line that we call modified adjusted gross income. So essentially, how much of your income is taxable by the IRS.
Mm-hmm.
And it's that figure that we're using to say yes or no compared to the threshold amount. So the reality is that, the forms that I'm filing this year in March relate to the income I earned last year.
Mm-hmm.
So although I'm filing the forms in 2026, it's my income from 2025. And so this leads to one of the challenges with this IRMAA calculation is that if I was going to start Medicare, say in October, the assessment applies to January of 2027. So effectively, it's my income that I earned in calendar 25 that I filed in calendar 26 that's used to calculate my premium for January 2027. And so for some people, this feels like, well, wait a second, I earned that money a long time ago. It feels as if it's a penalty in a way, but that is just simply how administratively how it rolls out.
That makes sense. There's a little bit of a lag before this kicks in, just generally speaking. Okay.
Exactly.
And I'm sure we'll talk more about that. And you mentioned the modified income. I think in my research, it showed that these surcharges start to kick in at somewhere around $109,000 for an individual and $218,000 if you're filing jointly. And once again, these numbers are current, but they adjust over time. So be aware of that if you're thinking about this possibly impacting you.
Yeah. So 2 observations. And, obviously compared to visiting with you in episode 19, we're in a deeper end of the pool now than we were then. So the figures that you're quoting, I would say those are sort of the low end of the threshold. There is actually several levels. So there's a beginning level where a person pays more than the standard Medicare Part B premium, but it goes up even higher than that. There's a couple of different levels. So there is a yes/no question, and then there is also a how much question based on income. Another sort of complexity here is that premiums for Medicare are individual. So say my wife and I, if we were 2 Medicare eligible people, she has a Medicare Part B premium, I have a Medicare Part B premium. But it's, of course, really possible in real life, I'm 6 years older than my wife, that I might be in Medicare and she might not be.
Mm-hmm.
But if we are married filing jointly, we are considering household income, even though I'm the only one paying a Medicare premium.
Okay. Yeah. So it gets complicated quickly.
It does.
As everything with Medicare does, which is why you're here with us today, Tim. So appreciate that.
Yes.
I think the other scenario that can come up sometimes is for folks that they possibly see an increase in their retirement income because of RMDs. So maybe someone retired at 65 and now they are turning 73 and having to take these required minimum distributions from their investment accounts. And then now they see their income level go up.
Yeah, that can certainly happen, right? I mean, you all being in the business of DRS and deferred compensation, you're aware of these challenges that folks have. So I'm not a certified financial planner or a tax professional, and certainly people who have this concern should consult with someone. And this is a personal observation. I'm not representing the Office of Insurance Commissioner. Charitable giving can help you with that required minimum distribution, right? So you could use that to offset instead spending it on your own self or paying taxes on it, or even having it count against you for purposes of calculating this IRMAA. But yes, that is a thing that people, Jenny, who, maybe retire at 65 and they're thinking, gee, I'm going to wait to collect my Social Security benefit until age 70, right? Because you're going to earn about 8% a year more if you defer until age 70. But that's also the time when we start talking about mandatory distributions from retirement accounts. And so it is possible that people could experience kind of a surge of income beyond age 65. So that would be the likely exception case to encountering this when you were starting Medicare.
Perfect. Thanks for that.
Yeah, of course. And I'll just say again, consult with a certified financial planner or a tax professional, because it's a thing that you can plan ahead for, right? You can kind of see it on the horizon.
Yeah.
And to Seth's observation, your consultant will know, but the numbers do change annually.
When I was researching this surcharge, I always get confused about Medicare. And we did a separate episode with Ellen, was the person from the Healthcare Authority.
Oh, yeah. That's my friend Ellen Wolfhagen.
Who recently retired as well.
She did.
Yeah. So Ellen came in and talked to us on episode 31, just a little bit about all the different parts of Medicare. And this is where I oftentimes get confused. There's a part A, a B, a D. There's gaps and advantages and all sorts of things that sometimes confuse me, because sometimes they're talking about the same thing with different names and letters. But in researching this surcharge, it seemed to me that the surcharge applies to Part B and to Part D. Is that accurate? And could you just remind us what those parts are and what they do?
Yes, absolutely. It is accurate. And my friend Ellen did retire to live in New York City, and she's doing well. I check in with her periodically. Yeah, so maybe we could just spend a minute here and kind of unpack that. So in general, we think about Medicare as an entitlement program of the federal government, similar to Social Security. In fact, when Medicare came online in 1965, it actually amends the Social Security Act. And so it borrows a lot of the same, administratively, the same provisions as with Social Security. So Medicare Part A, you'll hear referred to as the Medicare Trust Fund. So while I'm working, I have a payroll deduction that it gets invested in the Medicare Part A Trust Fund, so that when I retire, I do not have a premium for Medicare Part A. Effectively, I've paid into the system, similar to Social Security benefits. For Medicare Part B, that's an optional benefit, has always been an optional benefit. And so that is more like a pay-as-you-go kind of situation. So in current law, Medicare Part B premium, which is $203 in 2026, represents 1/4 of the cost of the Medicare program for Part B. 3/4 is paid out of basically the general fund of the Treasury. So every year, because it's an entitlement program, there does not have to be an appropriation bill, but every year Congress is funding the 3/4. That's the federal government responsibility. So to my earlier point, this is where the government said, hey, we could sort of save some money if we increase the Part B charges for high income earners.
For some people, yeah.
Yeah, exactly. So it's a political solution to that increasing cost every year to the government of Medicare Part B. Medicare Part D is the Medicare prescription drug benefit, which is the most recent change in the program. It's essentially a benefit that is endorsed by the government, but private companies contract with the Medicare program to offer the prescription drug benefit. And because it came after the Medicare Part B surcharge, the thinking was, well, kind of sauce for the goose is sauce for the gander. And so we've already got this sort of paradigm in place for Medicare Part B high income earners. Let's just apply that same logic to Medicare Part D, because again, the government is subsidizing those Part D premium payments.
That's perfect. That helps a lot. And you said in an earlier answer that this surcharge steps up. The higher your high income is, the greater the surcharge. And you mentioned that if you're not a high income earner, Part B is costing you about $202.90. But then if you are a higher income earner, it can cost you starting at $284, but all the way up to $689 based on my research in 2026. And these are assuming that I was looking up at 2026 numbers. But roughly, that's a $400 increase from the low end of the threshold up all the way up to almost $700. So does that all check with you? Does that sound right? Am I understanding that basically correctly, that it steps up as a person is earning more? I shouldn't even say as a retiree, because to your earlier point, as somebody who's paying for Medicare, somebody who's over 65.
Yeah, that's exactly right. Again, I apologize. I don't have the figures here, but there is a range. And so, yes, at the low end of the threshold, 284, at the high end, 689. Directionally, that's correct.
Okay. So it is a pretty big difference. If somebody was initially paying $208, they weren't a high income earner. And then if they are or become a high income earner, it can go up all the way almost to $700, almost a $500 difference. But to your earlier point, it could also go in reverse.
Correct.
They start off on Medicare as a worker, as an employee, they're getting a higher income, and then their income drops, and then their Medicare B cost can go down by almost $500 if they were at the very high end of the threshold.
That's exactly right.
Okay.
Obviously, my wife and I are not going to be people who are going to meet this income threshold, not because we were not responsible adults, just because we have relatively modest incomes. But to illustrate your point, yes, Seth, if I was going to qualify for Medicare in 2026, we would be looking at the income I had when I was still working as well as my wife's income. And so it may be that I had relatively higher income based on the wages we had when we were both working. And then subsequently, it may go down again when I stop working, or even down again more when she stops working. But then to Jenny's point, it might kind of move up again when I have to start taking money out of my deferred comp account at age 70, or if I start cashing my Social Security check at age 70. So yeah, it definitely could kind of float up and down, either in or out of the range of the threshold or within the higher income brackets.
That all makes sense. Jenny, does this raise any more questions for you?
No, not really.
Couple things I could add here. This is not on our sort of top 10 list of questions that we get generally for the volunteers. But when it does come up, besides being startled, of course, people are startled. They didn't know that this was a provision of the Medicare program. But then the two most common questions are, can I appeal this decision? And the answer is yes. You can ask for a redetermination, and there's a formal process of doing that. Again, we're talking about through the Social Security Administration, so ssa.gov. They have a form. You can download the form, fill it out, and send it back. So you're essentially saying the income that you used to assess my income is not correct. Use this amount instead, right? And then the other is, to your earlier point, Seth, it changes. So just because you have an assessment at a certain level this year does not mean that it's going to continue. So those notices, if you're a person who is going to have an assessment, would come to you in December for the year ahead, starting January. The most common cases, people have the Part B premium deducted from their Social Security check. But for some of these folks who are these very high income earners, their income from sources outside Social Security is going to be higher than their Social Security benefit. So the likelihood is that they're actually paying Medicare every quarter for their Part B premium, either through electronic funds transfer, or they're writing a check. So it would sort of swamp their Social Security benefit. So deduction doesn't make sense. So then we're helping people navigate how to just make sure that the assessment kind of comes and goes appropriately, so that, especially in the case of like an electronic funds transfer, you don't want last year's amount to come out of next year's check if it ought not to.
Well, Tim, I think you kind of touched on this a little bit, but then does Medicare send out a notice to folks saying that, now we see that your income has increased, you're going to be charged this surcharge?
Correct. That's exactly right.
Okay.
Yeah, that's a great question. And it's not a mid-year change. It's always going to be based on the income tax return that you filed. So obviously, lots of times people do things like, estimated returns or adjusted returns. And so, that can create some kind of administrative challenges for people. But yes, generally, the changes are going to show up in January based on the income tax return for the previous year's income.
I feel like health insurance is always complicated, but it gets more complicated as you're a retiree. And I feel very similarly about taxes.
It's ironic.
Yeah. Taxes get more complicated as you become a retiree. At least I feel like this is what I hear from retirees, that never knew about quarterly taxes until you start talking to retirees. And yeah, there's a lot more things to keep in mind.
There is. And one of the things I wanted to bring to our conversation today, just for awareness, speaking of, things that are different after you retire, all of the counties in Washington State through the Department of Revenue have a program where you can get a reduced or an exemption from your property tax. And so for people who are not aware of that, that's absolutely something you should check in with your county administration. But there is that provision. So the point is, if you are a person who is having this surcharge because you're a higher income earner relative to your Medicare Part B premium, the costs that you're paying for Medicare are deductible. So if you're a person person for whom property taxes get to be burdensome after you retire, and health insurance premiums, including Medicare, are contributing to kind of your uneasiness, then those are an allowable deduction for folks who are seeking a property tax exemption.
That's great. And maybe a future episode to find someone from the Department of Revenue to talk about this for retirees. That feels like a good public service to remind people that's available. So.
And you and I are, Jenny, we're all talking here in the first part of March. Hopefully the session will finish on time Thursday, right? Touch wood. But there is a bill that's under consideration that would, rather than having people itemize for purposes of qualifying for a property tax exemption, they'll just set a minimum threshold that everyone gets to write off. I'm going to get the number wrong, but $25,000 and allowable deduction. So yeah, I think it would be worthwhile for you to consider having somebody from DOR come in.
Yeah, that's a great idea.
The other thing I would just raise. Obviously, today's episode is focused on, the most fortunate people, the higher income earners. But there is also, on the other side of that, for low income earners, the state can pay the Medicare Part B premium. So we would talk about the standard Medicare Part B premium, $202.90. For our low-income earners, similarly, there's a threshold. If your income is below a certain amount, then the state will pay the premium and essentially put the money back in your Social Security check. So the observation is just that we talk about a standard Part B premium, but some folks pay more and some folks can pay less or nothing. The other observation that somewhat relates, sometimes people who are higher income earners, when they're working, are going to choose from their employer what we call high deductible health plans that attach to a health savings account. And for those of us who work in state government, we have that option. Those are the folks who, again, need a consultation with their certified financial planner or tax professional because they need to not enroll in Medicare Part B at age 65, because that will effectively create a penalty situation for contributions to their HSA account. So this is a little bit next door to the specific conversation about the IRMAA, but for high income earners who are, while they're working, contributing to an HSA, then check in with a SHIBA program or check in with your tax professional about whether it's okay to enroll in Medicare Part A while you're still working.
That's great clarification. With all this stuff, it is in the details where people really want to dive on their own personal situations. And that's why it's great that the SHIBA program exists and allows people to come in and ask those sorts of questions. So
yeah. And of course, our bread and butter is just, 1/3 getting started in Medicare, 1/3 Medicare open enrollment is coming, what should I do? And then 1/3 just the friction of using your benefits, on the regular. So we always want to hear from people who are having, a challenge using their benefits and eligibility, enrollment, claims, potential fraud, but really holding ourselves out as a full service, support through the Insurance Commissioner's Office. So meaning to say that we appreciate the conversations with high income earners as much as we do with low income earners.
Yeah.
So I think just as kind of a general summary, so these IRMAA surcharges can apply to folks who are in Medicare. And if you're over a certain income threshold, about $100,000 for individuals and about $200,000 for those who are filing jointly, and that's annual income. And that it sounds like it can affect both Medicare Part B as in boy and then Medicare Part D as in drug.
Yeah, that's exactly right.
Perfect.
Yeah. And as we said, when we talk about that income threshold, it's your adjusted gross income, right? So it's after, that preliminary deductions. But yes, that's correct.
And then, of course, if folks do have more questions, the SHIBA program is a great group of volunteers that can answer your questions. And Tim, just remind us what that website address is.
Sure. So for people who are on the computer, we're going to have you navigate over to insurance.wa.gov. And you can look for the SHIBA program. We're always obviously recruiting people who want to be volunteers and help in the community. If you're a person who wants to call, that's 1-800-562-6900. And we live answer the telephone 5 days a week, excepting, holidays. So you can connect with a real person in real time, and we'll get you connected to a SHIBA volunteer as soon as possible.
Thanks for joining us, Tim.
Thank you so much for having me. It's lovely to see you both again.
Thank you.
All right.
Thanks for listening, and now we'd love to hear from you. What topics would you like to hear about? What questions do you have for us? send an email to drs.podcasts@drs.wa.gov. That's drspodcasts@drs.wa.gov. The Department of Retirement Systems provides this podcast as a public service, but it's neither a legal interpretation nor a statement of DRS policy. References to any specific product or entity do not constitute an endorsement or recommendation. The views expressed by guests are their own, and their appearance on the program does not imply an endorsement of them or any entity they represent. Views and opinions expressed by DRS employees are those of the employees and do not necessarily reflect the view of DRS or any of its officials.